Good morning and welcome back to the latest edition of the InvestTalk Market Analysis for the week ending September 2nd, 2023. And today I'm going to title the video, Bad News is Good News. Poor jobs data equals relief rally. And that's kind of what we saw this week overall. And I'll dig into the details a little bit more, but I am host of InvestTalk, Justin Klein. And I appreciate you all tuning in and liking and subscribing to this channel. Now, today we're going to start off with the economic data. We got a good amount of economic data this week, and we start off with the non-farm or the JOLTS number, the JOLTS job openings, and that was the first sign that the Friday number was going to be weak, and JOLTS decelerated by another 400,000 jobs, so lowest level since early 2021, so nearly 2 years plus. Okay, so that's something to take note of, and obviously is a harbinger to a weak economy and a weak jobs market. Now, core PCE that was flat, so the Fed was going to like to see that, continue month over month, not a reacceleration, and an inflation picture that looks reaccelerating. I think it's going to be harder for inflation to come back down further from where it's at now. But it's going to be a slow slog back to kind of the 2% level, which is their goal. But at least you're not seeing a reacceleration to the upside, at least on the PCE number, which is something they definitely watch. Now, the personal income, that was only up 0.2%, and then personal spending was up 0.79%. So it shows that income growth is slowing. Frankly, the Fed kind of likes that. They don't want to see the income growth too high. And then spending reaccelerated. So there's still a lot of money on the sidelines that people have to spend, and they are spending it. So personal balance sheets are pretty strong compared to pre-pandemic. Then we had the jobs data on Friday, non-farm payrolls coming at 187,000 after they also revised down the last 2 months as well. So I believe the 187 was slightly ahead of expectations, but the 157 obviously is a step down from what the previous report was in July, which was I think somewhere in the 170s, 180s, and then June was already down all the way down to 105. So you can see 3 months in a row of sub 200,000 job creation. That is a weak jobs market. No longer an okay jobs market. When we were sitting in the twos for a long period of time, you were in an okay jobs market. Now we're in a jobs market where the unemployment rate is going to go up, and it is. And that was kind of the big number, the big headline number, 3.8%. But a lot of that too was more people coming into the jobs market. So that ticked up labor force participation up 20 basis points. So that was not all of the rise in unemployment, but certainly a big part of that. So average hourly workers, that was a decelerated to 0.24. Another indicator to the Fed that, hey, we don't need a raise anymore. And you see that in the odds for Fed hikes. Coming up later in September, it was 80% of a pause, 20% of a hike a week ago. Now it's at 94% of a pause. So almost assuredly going to pause in September, see what more incoming data they see in the month of October and into November 1st Fed meeting, which it was only a 44% chance they were going to be at the current rate. Now it's up to 64% chance. And same with December, that was only a 44% chance of being at the same rate we are today. Now it's up to 62%. And the chances of an actual cut have gone from about 2% all the way up to 5.6%. We're in the mind, pause throughout the rest of the year. I don't think the Fed's going to raise or cut interest rates just based on the economic data. So that's kind of what we are seeing right now. And let's dig into the charts first. And we'll start off with the S&P. And obviously, it's a nice relief rally. And that was on the back of, was the JOLTS number leaked? That's a question. And that certainly helped the market rally. Once again, bad news is good news. And it's all about where future interest rate policy is going to be. Now, what's interesting here is that you saw a rally in short-term treasuries, pricing in more of a weaker monetary policy or more dovish monetary policy. But you had a reversal on Friday. So I thought that was interesting, even despite a poor jobs number. The 10-year, that was up nicely, closed at about 4.17. That is down for the week, but not in a big way. So the 10-year remains kind of sticky higher. Let's look at the growth to value ratio. That did get a nice move higher, trying to break out again, but are we going to fail? You certainly had a rougher day on Friday, but that'll be interesting to watch if we get movement up into new highs or we get another rollover, kind of what we did in mid-July. And obviously that would weigh on the broader indices. Now let's look at the VIX. This is keeping the equities buoyant. You're having VIX just grinding to new lows. I mean, we're closed. I think this might be the lowest closed, since June. So that's a harbinger to higher asset prices. And you see the MOVE index as well, the volatility of the treasury market. That's going lower as well. Pricing in, hey, the Fed might be done hiking. So that's certainly a positive sign for risk assets, excuse me. Now, credit markets, so we have the junk bonds to treasuries still holding in there. So that is obviously bullish. You had the energy prices. Oil was up big on Friday, and just look at this. The UBS, the Bloomberg Commodity Index. This is strong. It's basically been in a nice solid uptrend since the beginning of June. So something that I'm continuing to watch, and it shows that, hey, that growth to value ratio I do think is going to roll over, but that probably means more of, in my mind, a sideways market, probably through end of the year, a choppy end of the year. So here's the NYSE. And we've had that pullback refreshed at the 100-day moving average, and we are into some resistance. So it would not shock me to get a lot of backing and filling before the end of the year. And typically you get that Santa Claus rally, and so you tend to close near the highs of the year. But we shall see. But that's something I'm kind of expecting overall. Let's see, what else do I want to get into? Let's go to precious metals. Here's gold. Gold had a nice up week on the back of a dollar that actually was a bit stronger. Look how strong it was on Friday. That was very interesting. And the gold market didn't really react to that. So the gold is actually up on Friday. So that's certainly of note. Silver to gold ratio, we talked about that breaking out to the upside. It did reverse. We'll see if this gets a reverse back to the downside. That certainly could be possible. Something we are certainly watching for signals in the precious metal market. XLF, you see that is kind of in the no man's land. XLI, the industrial space, that one is having good relative strength. KBE, the banks, relative weakness. As I say, the banking industry overall, just not a huge fan of at this point. SMH, the semiconductors, they're hanging in there. We had the NVIDIA earnings, and everyone was saying that was a catalyst for a major sell-off. We got a nice reversal trying to test those highs, but we had a reversal on Friday. So this is going to be very interesting. NVIDIA is the leader now. It used to be Tesla of the kind of high-valued, high-multiple growth stocks, and Tesla's rolled over. It's still in a longer-term downtrend, whereas NVIDIA, it's making all-time highs. So this is the leadership, and if this fails, that would be a good indicator of what's going to happen in the broader market. Google, obviously, still down from their highs, but they were one of the best performers from the earnings season of the larger cap tech names. The Netflixes of the world, they are more underperforming since their earnings reports. Let's look at Amazon. Amazon was a winner, but not quite as good as Google. And let's look at Apple. Apple had good earnings, and that one's probably been the best winner overall. And I still say Apple is the best business of all of these large cap tech names. Right. So overall, let's go back to the SPX. So we've rallied. We're rallying into resistance. The MACD is diverging. Look at this. That is an indicator that we're probably not breaking out. This is a big move, and we did reset back to the 100-day, but it's not anything that is. It's not a reset that will power another very strong move to the upside, most likely. And the cross currents I'm seeing in the market are telling me that I don't think it's going to break down in a big way, but it's probably not going to break out in a big way either. So Near term, a lot is up in the air with the economy, with the Fed, with earnings trajectory and the jobs market. Is it hard landing, right? We're clearly going into some sort of a landing. Is it a hard landing? Is it a credit event? The credit markets are not telling you it's a credit event yet. So that kind of says hard landing for now. For now. But obviously that could change, and that's why we're here trying to break these down for you and help you understand the trends that are in the market. Appreciate you all tuning in. Hope you have a wonderful weekend. A reminder that the contents of this video are for educational purposes only and should not be be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KPP Financial and those associated. Have a wonderful weekend.